Alright, so this is for sales mix selection for managerial accounting for chapter 23. So, this video focuses on choosing the sales mix or the most profitable combo of products for the maximum profit. So, when a company sells a mix of products, some will be more profitable than others. And so, usually it is wise for management to focus on the more profitable ones in order to increase profit. If production facilities are limited, an increase in production and sale of one product usually requires reducing production and sale of other products. So, management must choose a sales mix in order to increase profit. So, to identify the best sales mix or the best profitable combination of products, management must know the contribution margin of each product, and as well as the facilities required to produce each product, any constraints on these facilities, and the markets that these products will enter. So, an example problem in the book on page 992 is Fast Track again. So Fast Track makes and sells two products, products A and B. The same machines are used to make products A and B. So, in order for Fast Track to be the most profitable, it would have to choose one product to produce instead of two, because the same machine makes two products. So, because of this, there's three specific cases in which Fast Track should choose one product or the other. And so, case one, well, let's look over the info first. So, the selling price per unit for Fast Track is product A is $5 for the selling price. Product B is $7.50. The variable cost per unit for A is $3.50 and variable cost for B is $5.50. And so the way to find contribution margin is to subtract these two in order to get this. So taking the price and then subtracting the cost would get the contribution margin. So contribution margin for product A is $1.50 and for product B it's $2. So for case one, the machine hours required for products A and B are the same, so it takes 1 hour to produce a product. And both products are the demand is unlimited. So in this case, with 100,000 machine hours per month, the question would be to ask which product produces more contribution margin per month. So if you multiply product A's contribution margin by the machine hours per month, you would get $150,000. And if you do the same thing for B, it would be $200,000. So for case one, Fast Track would choose B. It would produce as many units of product B as possible, which would be $200,000. And so that would be the one they would choose. However, there are different cases. So case two, the machine hours required for product A is 1, but for B, it takes twice as long, and so it takes 2 hours. So, and demand is unlimited. So, if we were to look at that and do the same thing, product A, 150 times 100,000 machine hours would equal 150 still, but for case 2, for product B, this would only be $1 because it would take twice as long. And so $1 times 100,000 is $100,000. So in this case, Fast Track would choose product A. Let's put that down over here. So choice B, because it would produce $200,000. And then choice would be A, because it produces 150. All right, 3. So case 3 is a little different. It's similar to case 2. However, there's something different. So the machine hours required for product A is 1, and the same for product B is 2 hours. But, however, the demand is limited for product A, and I've listed the thing here. So A is limited to 80,000 units. So we would take this and times this to see what that would get. And so that would have, as you can see, 80,000 times 1.5 is $120,000. And we would take the remaining hours, 20,000 hours left, and that would be 20 times the equal sign, 20,000 times, let's see, it takes 2 hours for that, so it would be cut in half again, just like case 2. So it would be 1. So that would be 20,000. So if we add these together, it would be $140,000. So put that, make that money sign. So in this case, you wouldn't be choosing A or B. It would be using A all the way up till the limit is out, and then you would make B until the end of the month, and so that would equal $140,000. So in this case, we would be choosing which product to do in terms of which case is happening at that particular moment. So in this case 1, we would choose B because it produces the most. Case 2, we would choose A because it produces the most. Since product B takes twice as long, it would only produce $100,000, and this one still produces $150,000. And then case 3, the demand is limited, so we would produce $120,000 until the limit is up, and then we would go to product B and produce as much of that as possible to the end of the month, which would produce $140,000. That's it.